Good morning, everybody. My name is Robert Puentes, and I want to welcome you to the latest in our Eno Center for Transportation webinars. Today, we're going to present asset recycling lessons for the U.S. From Australia. And joining us today in our Eno offices in Washington is the Honorable Joe Hockey, the Australian Ambassador to the U.S., and Jennifer Almond, the Group General Manager for North America from Transurban. So after I do just a quick introduction here, the Ambassador is going to describe the Australian model of asset recycling that he created and implemented when he was Treasurer there in Australia. And Jennifer will have plenty of time for questions and comments that you can submit via the questions function on the webinar website. You don't have to wait until the presentations are done to submit questions. You can do that at any time. And we think actually this webinar really couldn't come at a better time. As we all know, infrastructure is high on the agenda of the Trump administration, as well as congressional leaders on both sides of the aisle. And while many of us are probably frustrated by the lack of action, a few ideas for how to invest and reinvest in infrastructure are beginning to bubble up to the surface. And one of those ideas is this notion of asset recycling. I think while there's a lot of attention to this issue now, there's actually not a lot of deep knowledge about what it is, particularly here in the U.S., and so that's the purpose of this webinar today. The Ambassador is going to describe this in more detail, but in short, asset recycling is the selling and leasing of public assets and then using those proceeds to pay for other infrastructure. Asset recycling always involves at least two pieces of infrastructure, the asset being sold or leased to the private sector, and a second piece of infrastructure, generally unrelated to the first, that's built with the proceeds from that sale or lease. So the name asset recycling comes from the idea that the value of the old asset is recycled to pay for the new asset. Asset recycling is a type of a public-private partnership, though not all PPPs do asset recycling because they may not have that second component of investing in a different piece of infrastructure. But a lot of the conversation around asset recycling and PPPs and public-private partnerships are tightly related. We do have some examples here in the U.S., which I will discuss in just a minute. But first, let me go ahead and introduce the Honorable Joe Hockey, Australia's Ambassador to the United States. Mr. Hockey became Ambassador in January 2016 after a long and distinguished career in public service. He first entered the Parliament there in 1996 and served as Minister in a number of different portfolios. In 2013, Mr. Hockey was appointed Treasurer of the Commonwealth and was responsible for all economic policy, including fiscal policy, and it was there that he established the asset recycling program in Australia. We're honored to have him here with us today. Please take it away, Mr. Ambassador.
Well, thank you, and hello, everyone. Good morning. And welcome to the webinar. I want to emphasize up front that it's not for me to give gratuitous advice to the United States. That's actually not part of the definition of a job of an ambassador, but it is an area that I have some experience, both as Treasurer of Australia, but also as the Chair of the G20, because Australia was the chair of the G20 in 2014, and this initiative went global, and a number of countries are looking at it or variants of it since that time. The simple issue is that governments have run out of money. Now, some governments have recognised they've run out of money, others have simply not come to terms with that, and but the bottom line is governments everywhere have run out of money. And when you've got limited capacity in fiscal policy, and when you've got monetary policy, being interest rates at an all-time low, the question is, how do you build infrastructure that is going to grow productivity and grow your economy? Only through strategic and microeconomic reform are governments going to build their economies. And one of the areas to do that is to have a better approach to the use of government assets. The United States takes some pride in being a free and open economy, but it actually has a lot of state-owned enterprises, right up there with China in many ways. For example, all your major airports are owned by counties and cities. In fact, there's probably around $600 billion of airports that are owned by counties and cities. Those airports, well, they don't pay any dividends to their shareholders. They borrow money and get it subsidised by taxpayers, which I find utterly extraordinary. with municipal bonds. It's crazy, and not only that, they don't pay tax. So they're a big liability on the balance sheet of your counties and cities, but effectively they don't contribute anything as a business. And yet airports compete. The classic example, Dallas-Fort Worth, is now competing with a private sector airport built just a few miles away, run by Ross Perot Jr. And Ross Perot Jr. successfully captured part of the value of Dallas-Fort Worth in order to build his basically airport that runs on freight, so as well as the surrounding suburbs and districts and NASCAR tracks and everything else. So when I found that we didn't have enough money to be able to build infrastructure in Australia in 2014, I looked around state governments and saw that they owned a number of different assets. They had ports, they had electricity companies, they had assets that I'd never heard about, lotteries offices. They owned, even believe it or not, registry offices for the registration of property ownership, particularly housing ownership. And I said to them, look, what have I got to do to get you to sell or lease those assets? Because if you lease them, they'll become federal taxpayers. They'll pay me company tax. And they came back to me and said, well, you've got to give us an incentive because the politics of it is really hard. It's not popular to lease electricity. It's not popular to lease a port or to sell an office or to sell land. And I said, okay, well, I will give you an incentive only on the basis that the money that you get from the proceeds of the sale is reinvested in new infrastructure. And accordingly, what we did was we cut a deal. And the states came to me and said, right, this is what we propose to do. We will lease this port. We think we'll get, say, $100 million. I'm plucking numbers out of the air. I said I'll give you a 15% bonus if you sell and redeploy or lease the airport or the port and redeploy the $100 million into new infrastructure. But it'll be time limited. The offer is only there, and you've got to put to me the proposal that you want. So, okay, you want to lease this port. What are you going to put the $100 million plus the $15 million I'm giving you? What are you going to put the $115 million into? And they came back and said, well, we'll put it into maybe upgrading these roads, maybe building these, upgrading the electricity infrastructure, whatever the case. And I signed off on the deal. I said, I'll give you half the 15% now, half when you have started the entire deal, when it's completed. But most importantly, I want the sale process and the construction process to begin at exactly the same time. I need the economic activity. I need the cranes. So as you can see on that first slide, because the federal government in Australia basically didn't own much, it involved in welfare and defence and a range of other things, but basically we provided an incentive for the state, county, municipal government and said, right, first in, first serve. So it's not delivered on a proportional basis to the bigger states versus the smaller states. It's a one-off, time-constrained initiative, which that in the end creates a sense of urgency and competition amongst the states. Very, very important to get things going. Once they came to me, once I agreed to the leasing and building deal, we gave them half the 15%. They redeployed it to the new infrastructure, and then I'd release the money at the end. The key thing is, what are the benefits? This is the only piece of infrastructure spending that is self-funding you'll ever see. Because these big state-owned enterprises don't pay any tax at the moment to Washington. In my case, they didn't pay it to Canberra. All of a sudden, they come into the tax system. And yes, they do compete. The ports in New York compete with ports in Canada and ports in other parts of the world. Railways compete with roads. Electricity generators compete with renewable energy sources. They actually do compete. The concept of monopoly is essentially over. And there are there are increasing forms of competition, and certainly, for example, as you know in America, airports compete with other airports in different states. So there is a competitive environment. Secondly, because that revenue comes back, that gave me the financial capacity to pay out an incentive now. So I'd pay out an incentive, pluck a number out, $100 billion. It'd take about, and if that were on a 20% basis, that means you'd be selling or leasing $500 billion of assets. And that $500 billion combined with your $100 billion would be going into $600 billion in new infrastructure. The total outlay by the federal government would be just $100 billion. And because those $500 billion of assets that have been leased suddenly become taxpayers, and because you're building new infrastructure which generates economic activity that in turn ends up delivering you tax receipts, you get your money back as a federal government in 5 to 10 years, but most importantly, you've extended the tax base, and in perpetuity, you get revenue from that tax base. It's the most painless way to broaden the tax base. Most painless way to broaden the tax base. Most importantly, for all those counties and cities, they will be able to charge tax as well. Local taxes would be charged to the airports or the ports, which currently they don't get. And as well as getting the revenue, they would be able to spend it on the projects that are most needed in the local communities. What's the downside? Well, frankly, I've been asked that on numerous occasions. I don't see a downside. There are challenges. The challenges are, how do you spread the benefit across a whole state? I mean, you might have, for example, in Charlotte, there might be the local council, the local city that owns Charlotte Airport. How do you ensure that if they get a massive windfall, pick that airport, say it's worth $10 billion, how do you ensure that the $10 billion of proceeds are actually extended across the whole state? Well, that comes down to the structure of the transaction and whether you're providing a 20% incentive or not. So the federal government, in my view, here in Washington should provide a 20% incentive. And part of that incentive should be about giving a city or county the right to share that around, or they have to share it across the state. It's also the case, because of the dynamic nature of the American system, that you might choose to have different programs associated with the asset recycling that ensures that regional areas get access to some of the proceeds, or certainly have another pot of money that is available for new infrastructure. I just emphasise, it doesn't, in the current low interest rate environment, you've got a once-in-a-generation opportunity to lease assets for 49 years and get the same return value as if they're sold 100%. So be it toll roads or railways or anything else, and I'm not sure that I'm being kicked under the table by my next speaker, but it is a fact that you can drive a great price, and because of the very low interest rates at the moment. Who else would be the potential investors? Potential investors come from all over the world. I think there's a good argument for local pension funds to be investors in these assets. Certainly workers' funds, union-based funds, they could be buying into the assets that are leased. In fact, the very best bids for assets in Australia came when the union funds were partners in the potential purchase of the asset. It won over the workers. The trade union movement in Australia actually is one of the strongest advocates for asset recycling around the world. And that's because they can see the benefits for the workers, and they can see, importantly, the benefits for their own funds. And with low interest rates, again, I emphasise, you can get maximum value at the moment and maximum control, ongoing control for the vendor. In some cases, you might want to have pricing regulation, given a bit of a debacle in relation to parking meters in Chicago and some other bad experiences. I would argue that you should have some form of pricing regulation as part of the vendor contract. It's also the case that counties and cities across America just aren't experienced in privatising $10 or $20 billion assets. I mean, they just haven't got the expertise. And that's where the National Governors Association, I think, has a role in building a team of trusted advisors who can develop the expertise to help counties and cities right across the country put in place mechanisms for the leasing or sale of assets. Has it worked in Australia? Absolutely. We've got $17 billion in new infrastructure development with only $3 billion of spent. And most importantly, it triggered a vast amount of new activity. There's a photo up there of the New South Wales Premier, Gladys Berejiklian. It is because New South Wales, which is the biggest state in Australia covering Sydney, embraced it wholeheartedly, took the politics head-on of leasing electricity, won an election on the basis that the whole debate was not about leasing electricity assets, it's about what they were going to build. That's how they ran the campaign. What are you going to build? And all of, during the campaign, the whole debate about privatisation and leasing was insignificant compared to the debate about whether you were going to spend the money on these brand new roads, whether it should be railway or whether it should be sporting stadiums or anything else. The net result is the political party that went down this path had a bigger pot of money to spend on the community than the other party that said it was going to just raise taxes to pay for it, and it worked. And Sydney today has the most number of cranes of any city in the world. And 350 operational cranes in the city and 48 tunnel boring machines under the city building new railways and roads. And the city is, the state of New South Wales is running a budget surplus and it has no debt. And why? Because it's made these decisions. So you can either do it when it's easy or you can do it when it's hard. Easy, example of New South Wales and that Premier up there who embraced asset recycling and now have rolled out new infrastructure and the city is humming and the state is humming. Or you can do it the hard way, Exhibit B, which is Brazil, which at the moment, because of its terrible budget, is actually desperately trying to sell assets. Some would suggest it's a fire sale. I don't agree, but they're selling assets in order to try and get the proceeds from those assets to put into a massive amount of new infrastructure to try and rebuild the Brazilian economy. Either governments, when their debt is in trouble, have fire sales, or governments actually do it when they can get the best price and deliver the best continuing outcome. Finally, I just make the point. Australia hasn't had a recession for 26 years. It's the longest continuous period of growth of any developed nation in history. I would suggest, touch wood, it's probably at least another decade before I can see any risks on the horizon. And why? Because it actually is making these sort of hard decisions. And you can only build infrastructure through hard decisions. Nothing is easy. I understand totally the politics of privatisation. I've been doing it for 25 years. I know the politics of being very unpopular as a politician. That's why I'm in Washington, maybe. But I can tell you, unless you undertake these sorts of changes, it's going to be so much harder down the track, and you'll never get the infrastructure you need. The United States, if it spent every single dollar of its budget this year, every single dollar of the federal budget this year on infrastructure, it still wouldn't cover the funding shortfall, the immediate funding shortfall for infrastructure in the United States. You need to spend $10,000 for every man, woman and child in the United States just to upgrade the infrastructure. You currently have $43,000 of debt per person. For every man, woman and child in the US, you need another $10,000 just to improve the existing infrastructure, fixing the potholes, upgrading the roads, etc. And if you have any economic growth, that's going to create further and new demand for infrastructure. So as I see it, there's not much choice. Thanks very much.
Great. Thank you, Mr. Ambassador. I know we're going to have more time for questions here at the end. I think your lessons are very helpful for us, and particularly the last understanding about the challenges that we have here in the U.S. in getting things done. And you clearly have the scars to show it from your experience there. And while we don't have a formal program here in the U.S., there are some examples of asset recycling here in the United States, even though we may not call it that. So I want to just quickly touch on two examples here, just to give folks a flavor for how this could work. Two examples that are already on the way and on the ground here in the United States. And one example that gets a lot of attention is the Indiana East-West Toll Road. And it started the scheme here started in 2005 when Indiana Governor Mitch Daniels needed a couple of $1 billion to finance this big statewide transportation initiative he had called Major Moves. It was funding all kinds of road and reconstruction projects all throughout the state. And so to generate that revenue, the idea was to solicit bids for this 150-mile east-west toll road that directly connects Chicago with the Ohio Turnpike. And in exchange for managing and operating the road, the private partners receive the tolls that are paid by the motorists, though the road will remain owned by the state. And in 2006, the Indiana Toll Road Concession Company was awarded the right to operate that road for 75 years. And so that's generally basic P3 transaction there. But the consortium got the contract in large part due to the $3.8 billion that they gave up front to the state, which was nearly $1 billion higher than their closest competitors. Now, as we all know, there were a lot of economic and financial fundamentals of this multi-billion-dollar investment that faced challenges right from the start. And the whole consortium eventually went bankrupt. But because of the way they structured the deal, there was almost no impact on the toll-paying public. And in addition, Indiana got to keep the initial $3.8 billion payment that it then used to pay for the statewide transportation plan. That project has now been refinanced and it's leased to another private consortium. But the idea here is that, and why it's a good lesson, is that it shows the value that one asset can be used to support another. In this case, it supported a range of different projects all throughout the state of Indiana. The second example, maybe not as intuitive, but close to us here in Washington and Northern Virginia, where recently Virginia entered into an agreement with a private consortium to build express lanes on a segment of I-66 outside the Beltway where the private partner could collect the tolls, pretty standard for some of these PPP deals. But this is an example of asset recycling instead of just a straight P3 because the private partner agreed to pay $500 million upfront for improvements in the corridor, and they also agreed to pay $800 million for transit service and $350 million for other improvements to the corridor over the next 50 years. So the value of the road is being used to support transit and infrastructure improvements, which is something that the state actually wants to do anyway. But it's using this transaction as a way to generate that cash to pay for those improvements that the state wanted to get done. I want to now turn it over to Jennifer Almond from Transurban to describe other potential applications here in the United States. Jennifer joined Transurban in 2006 and now leads the group's North American business. She's pioneered a number of innovative finance and technology strategies for infrastructure all across the U.S., including the $3 billion Express Lanes project on I-95 and I-495, also in Northern Virginia. Prior to joining Transurban, Jennifer worked for Bechtel Infrastructure to develop the Washington Metro Silver Line, among other things. With that, take it away, Jennifer.
Great. Thanks, Rob. Many thanks to the ambassador. It's always a pleasure to be in a dialogue with you, particularly on this issue, and also to the large group of participants who have joined this webinar today. I think it struck, the ambassador and I have been in several forums where we're talking about lessons learned from the Australian environment. Transurban is based in Melbourne, Australia, and has the pleasure of having experience developing infrastructure projects with government partners both in Australia and here in the U.S. and have a lot of lessons learned to share. While we can take a lot of lessons from the Australian experience and put them to work to the benefit of the U.S. market, I will tell you that we spend a lot of our time as well sharing lessons learned from the U.S. market with our colleagues in Australia. So it's really a great way to be able to share the best practices, particularly in the areas of innovative finance, programs like TIFIA and private activity bonds that have been successful in the U.S., and also sharing a lot of the innovative activity happening at the states. Many of those projects and initiatives being led by the people that are listening to this webinar today. So I want to acknowledge the great work being done there. And I think when we talk about asset recycling, certainly Transurban has seen the benefit of asset recycling in our hometown and the cities in which we operate in Australia, both in the ability to move infrastructure projects quickly and to maximize the value of public assets. But I will tell you, I think if you think about the application of the program here in the U.S., it's good to take a step back and look at the context of which we're talking about what could be a transformational program. Having, the public-private partnership market developed and been a participant in that over the last 15 years, I believe that the environment is ripe for a transformational program like asset recycling. If we think back to Rob mentioned the Indiana Toll Road in 2005, if we think about as an industry where the industry has come during that period of time, we've had significant amount of progress and a foundation of sort of momentum in the P3 market in the U.S. that would position us well to take on something like asset recycling. You've got policy frameworks now in 37 states across the country. You have states across the country who are showing a willingness, enthusiasm, confidence, and capability to move forward innovative P3 projects like the Denver Eagles P3, the Long Beach Courthouse, LaGuardia Airport, Ohio State University Energy Project, and the list goes on and on. You've got an established program at the federal government that includes resources and education for states across the country, and also now innovative finance programs that have been tested and refined and continue to be refined to provide credit assistance in the form of TIFIA and private activity bonds. And you also have financial markets who are showing an increased interest and comfort and demand for these kinds of projects. So if we think about Indiana Toll Road days, where we are today, if we can get a meaningful incentive at the federal level, states across the country are very well equipped, knowledgeable, innovative, the financial markets are keen, and we are at a situation where I think the environment would support and position for success a program like asset recycling. And I think some of the reasons that we've seen this success as we look back at the P3 evolution in the U.S. is we are starting to see examples in the U.S. market where this model, whether it's drive-through asset recycling or other means, that private participation in infrastructure is generating projects that are proof points that these kinds of partnerships can produce both commercial and policy outcomes. Rob mentioned a couple of examples in Indiana and I-66 outside the Beltway. If you look at our express lanes network in Northern Virginia, the Commonwealth of Virginia on the 95 express lanes will have generated 110 times its state investment and created $6 billion worth of economic activity around that project. In operations, customers are saving 30 to 40 minutes a day on average in their commutes. We're running more than 800 buses a day on that network. And even those drivers in the regular lanes next to the managed lanes are experiencing travel time savings as much as 17 minutes across a 30-mile stretch. So we're seeing it produce those significant transportation and economic outcomes while also generating a return for our shareholders. I think another dynamic we're seeing in the U.S. that will help create an environment that will make asset recycling work is we're seeing a shift in how we use tolling in the U.S. And tolling can be a big part of this program, the success of this program. Tolling, I live out on Little River Turnpike, the nation's first toll road, where back in the days when tolls used to be about paying for assets, and then assets were paid for, and then you took the toll off. And we are really changing in the U.S. market how consumers think about the role of tolling. On the express lanes in places like Virginia and Florida and Texas and California, customers are coming to expect that when they pay a toll, they're going to get a faster trip. They're going to get a more reliable trip. They're going to get a safer trip. They're going to have access, more convenient access to locations. And so we're shifting how consumers feel about tolling. That's why on our network here in Northern Virginia, we have 85% satisfaction rates from our customers. If you move to our frequent customers, that satisfaction rates exceeds 90%. And if you ask our carpooler customers, who use the benefits for free with 3 people in the car. That's 92% satisfaction rate with the transportation service. So as we see the nature of tolling changing, I think what it does is creates opportunities for us to develop projects that are much more politically palpable, because we can look at express lanes, we can look at service improvements on traditional toll roads, better information for drivers, incentive programs. Technology is allowing us to do put a lot of power and information in consumers' hands in their mobile phone to be able to improve their experience. And the better experience that we provide for the toll, the more politically palpable I think this option will be, whether it's delivered through asset recycling or otherwise. So with that context of a market that's building momentum, that's using innovation, that's now more open to tolling, more options for tolling, that has great proof points to deliver commercial and policy outcomes, what would asset recycling look like in the context of the U.S. market? If you look at the recent transactions just in my sector, so just in the U.S. toll road market, Transurban took a look at the 10 largest U.S. public toll roads alone, just the 10 largest, and we would value that group of toll roads at about $260 billion. Take the Australian asset recycling model, and that would generate as much as $150 billion for greenfield transportation projects in the states where those assets are. So again, just the 10 largest public toll roads we believe are valued at north of $260 billion, and an opportunity to generate $150 billion for greenfield transportation projects. Now, for those of you that dig in the details on that, that valuation is based on EBITDA multiples of between 25 and 35 times, which is consistent with recent transactions in the market. And when you look at those kinds of toll roads, and I'm by no means going to want to throw out single toll roads and suggest that we're targeting them, because I suspect some people on the phone will have something to say about that. But to give you a few examples, not targets, just random examples across the country, if you applied that logic to an asset like the New Jersey Turnpike, that could generate net proceeds of about $19 billion for greenfield transportation projects. If you look north to MTA, we believe based on that methodology that MTA could generate more than $25 billion to support greenfield transportation projects. And go ahead down south to Florida, the Florida Turnpike Enterprise, north of $19 billion for greenfield transportation industries. Again, not targeting those toll roads, may or may not be right for those public assets, but gives you an order of magnitude of the amount of value that is trapped in public toll road assets across the country. And these headline numbers don't include the potential here in the U.S. market across other sectors, water, ports, airports, electricity, and others, so you can see the scale. And I'll say a lot of our investors obviously are very excited about the concept of a federal incentive to help unlock some of this value. But it's worth saying and acknowledge for all of us who develop transportation projects in the U.S., we know they can be challenging. We know they can be controversial. We also know that this model is not a right fit for every public asset out there, not for every port and not for every highway or rail project. But for the U.S. market, given the scale of the U.S. market, even if a handful of these assets made sense, and it made sense for state government to enter into an asset recycling program incentivized by the federal government, it could create both meaningful investment opportunities in the U.S. market and also create a substantial amount of funding to support greenfield projects in cities across the country. And finally, I'll talk about, if we're looking at a federal incentive program like asset recycling here in the U.S., you see the scale of the market. In order for us to maximize the value of the existing assets and to maximize the value of the asset recycling program in the U.S., it would need to be coupled with a series of policy changes in the U.S. to make sure that the program could be successful here. A few of them, as an example, the first being expanding the existing private activity bond program in the U.S. that many people on the phone have used successfully, Transurban has used successfully to support our projects in the U.S. If you look at the potential for asset recycling in the U.S. public toll road market, expanding private activity bonds to allow for the use of brownfield projects or existing assets would increase the value by, we think, of at least 10%. So if you take a $100 billion program You're trying to generate $100 billion of proceeds to support new greenfield transportation projects. Make that private activity bond policy change, and you could turn that $100 billion, you could add another $10 billion to that to be able to put to work in new projects. So that's an important policy change. TIFIA could also play a role in helping to maximize the value of those existing assets in a similar way and to the similar extent. Other policy priorities or changes that could help maximize the benefit of asset recycling here in the U.S. include expanding tolling authority in the U.S. and linking that to incentives. You'll hear at the federal level that there are federal pilot programs available for tolling that states aren't using. If you expand that authority, put to work some of these more consumer-friendly tolling practices I spoke about earlier, and couple that with an incentive program, we think that could create meaningful opportunities. And finally, opening up the potential for federal assets to participate in this program as well. You can take a state-owned or city-owned asset, provide an incentive and unlock value in that. There are also federal assets here in the Greater Washington area and across the country that could be good candidates for that kind of program as well, given the appropriate policy framework to support that. So, Rob, I'll hand it back to you and take the questions.
That's great.
Yep.
Thank you very much, Jennifer. Very, very informative, and you can tell from the variety of questions we have coming in already. So I'd encourage folks who are still listening in to go ahead and submit your questions via the questions function on the webinar website. And I'm going to go ahead and kind of try to bundle a couple here and maybe start off broad and then get more specific. There seem to be a bunch of questions actually around kind of a fundamental question. Can you just lay out just what's the difference between P3s and asset recycling? As clear as you can, just lay that out for folks. I think there's some confusion about which is which and when are they more applicable.
Well, asset recycling is about a government taking the proceeds from the lease or sale of an asset and putting it into a new project. The new project might be a government contribution to a P3. It might be the government building a school at its own 100% cost. It might be a joint venture. It might be something else. But asset recycling is the overarching policy, and P3s are about what you do with the proceeds and whether you are prepared to build it in partnership with the private sector, or the private sector uses it as seed money, or maybe it might be just a government guarantee for a project.
And I think if you look at the U.S. context, Rob, and how we might put a program like this to work, in my view, it's not about translating the Australian experience or the New South Wales experience exactly as it was here into the U.S. market. It's the overarching concept of how can the federal government move from a role as educator to move to a role of providing a strong incentive for states to be able to look at the assets available and find ways to maximize the value of those assets. Now, that could be in the form of asset recycling, or it could be in the form of other incentive-based programs that try to work to incentivize states and localities to do more with the resources they have, whether that means looking at existing assets, whether that means looking at sales tax or vehicle miles travel tax or other benefits to be able to make dollars go further. It's that incentive that I think has been a very powerful tool that the federal government has used in Australia, whatever that looks like. And it could be in the form of asset recycling in the purest sense. It could be in the form of leveraging private capital through public-private partnerships. It could be in the form of innovative partnerships like we've seen on the Purple Line that combine the best of private capital and local, state, and federal government.
And you've mentioned a couple of times, Jennifer, the greenfield investments from the quote-unquote receiving asset. But in the U.S., the context, like Australia, it's a growing country. There's still a lot of new infrastructure. But the big challenge we have here in this country, as we all know, is the infrastructure has been in disrepair and needs maintenance. Do you think that asset recycling would also work for that kind of situation where we're trying to reinvest in existing infrastructure?
Yeah, without question. And I think that when you talk about the proceeds and you have a U.S. public toll road, a large U.S. public toll road that could generate, $19 or $20 billion of funding to be able to generate or to be able to address transportation needs. That could be in the form of new transportation projects. And if you look in a city like Sydney, they've benefited with increased rail as part of that project, but it's also benefited from programs that use technology to maximize the existing capacity that they have through a smart motorways program. So I think we all know in the transportation industry now that the solution is not always about concrete and steel. You look at the 66 example, you look at 395 that's producing $15 million a year for transit for the next 70 years. The solution has to be multimodal. It has to be a technology solution. It's not always a capacity solution. Sometimes it is, sometimes it's not. But regardless, generating funding to be able to meet those needs and to fund a variety of strategies to help address needs, safety, capacity, others in the U.S., I think will be an effective strategy.
So it's really limited just by the imagination or by the needs of different city states.
Yeah, and we've actually heard some feedback coming out of the feds that criteria for programs like this should prioritize, innovation in looking at what projects may be first in line.
And that's a question I want that it hasn't come up on here yet, but in the Australian model, how you choose the projects that are ripe for this kind of transaction, and then that receive the proceeds from it. The Australian model, you created a governance structure basically that was administering the fund, and that shows and prioritized and ranked projects.
No, I was the administrator, and I gave, because the politics is at a local level. So, the county and city that is leasing the asset has to deal with the local community. And so I give them maximum flexibility on what they propose. So the first state in Australia to come to me with a proposal was the Labor state, left-wing Labor state, and they came to me and said,
South Wales.
No, it was the ACT covering Canberra. And they said, we want to sell our disused public housing. We also have a lotteries office. We want to sell those assets and put the money into a new railway through the middle of Canberra. My own political party opposed that new railway in the middle of Canberra. But I agreed to the deal because I left the politics for them at a local level. I needed the economic activity. Let me be, and this is not the sort of thing that most people on this call would probably be focused on. You have to lift productivity. You have to lift infrastructure if you want to grow the economy. It's as simple as that. And from my perspective, I wanted cranes everywhere. I wanted building everywhere because I needed to fill the gap in the Australian economy, and this was the way of getting it done. The second thing is, it's usually the case that the locals who own the assets and then want to build new assets also have all the planning approvals, right? So the planning approvals don't come out of Washington, they don't come out of Canberra. The planning and development approvals come out of the local government. And that local government, if it's got a financial incentive to lease and a financial incentive to build, and it's got time constraints to access that financial incentive, that's where you get the activity.
And so were the projects on either side, either the ones that were leased or then reinvested in, part of a national strategy? Did the private sector know what would be more attractive for?
No, as long as they were productive assets. But I had other infrastructure pots of money. We had a separate entity called Infrastructure Australia. That separate entity had independently identified the major projects for Australia, and I then continued to work with the equivalent of the governors to identify how we could help to make them happen. Now, a little bit earlier, we were talking about other types of projects. One of the ones that I helped with was called West Connects, which is the biggest network road project in Southern Hemisphere. And tunnelling machines were operating on stage 1 in Sydney. And I said to the Premier, how can we keep the tunnelling machines going? Because as I understand it, and correct me if I'm wrong, tunnelling machines, when they've finished their job, they're basically turned to the left and right and they're buried. And I said, how can we keep those tunnelling machines going? And he said, well, it's a private-public part, P3, let's keep it going, you need to provide the incentive for me. So I gave him a financial incentive to make stage 2 and 3 work. But there are many other examples that have worked, including with our good friends Transurban, that have been very successful in getting projects underway, but the federal government has to be flexible.
I think this is an opportunity at the federal level to really look at how that program might be shaped here in the U.S. to help advance certain policy priorities, right? Because in looking at how you choose projects and how you prioritize projects as part of an asset recycling program, the federal government can certainly look at, levers that they can pull, priorities around economic activity that's produced by those projects, to the extent to which they leverage private capital, the extent to which they maximize technology or throughput, and we know the political realities here in Washington, the extent to which those funds could be used to help address rural transportation needs. Obviously, it's a big need in the country, and obviously a big factor when we look at politically how we can get some programs like this done. So I think that gets into the sausage making. If we were to have a program like this in the U.S., how do you shape that criteria to support some of those objectives?
Right. And there's a lot of questions on that very fact, on how you would structure a federal program, given that, as we've talked about, so much of this is coming from the city, states, and metros. They're passing their own legislation, they're doing the deals themselves. In this case, a federal program, at least with some of the lessons from Australia, would provide some kind of incentive, right, the financial incentive. Some would argue that we have TIFIA, we have PAVs, we have these incentive programs now, which are part of a lot of P3 projects now. What would be the right mix of federal incentives now, you think, that would unlock the potential for this here in the U.S.?
Boy, it's hard to say exactly what percentage of a project would be worth it. I would look to my colleagues on the phone who are on the ground in states and cities doing really innovative things as to what would be a meaningful percentage. Obviously, in Australia, it was 15%. The ambassador and his team determined that was appropriate. But I would just defer to my colleagues in states and cities as to what would be meaningful to be able to get that done. But the comment about TIFIA and PAVs, to say, well, we don't need a federal incentive program because we have TIFIA and PAVs. Well, the U.S. has a long track record of the federal government obviously providing incentives for states to try new transportation approaches. And I think we've seen that work in programs like the VMT or use-to-pay pilot programs that have been in the last reauthorization. And other examples, certainly the federal government has provided those incentives. And if you look at TIFIA and PAVs, the U.S. P3 market in the last 10 years, we have put billions and billions of dollars of projects to work, putting tens and hundreds of thousands of people to work through the benefit of those two programs. So building on that success and adding additional incentives at the federal government seems like a good way to continue that momentum.
And so something that's kind of come up a little bit, I'm reading between some of the lines here. In the U.S., we have such an atomized infrastructure network, right? We have a Federal Highway Administration, a Federal Transit Administration, states they kind of break it all up. We're talking about leasing these assets and then using those revenues to invest perhaps in other types of infrastructure assets, which are not toll roads going to more roads or trains going more. How challenging do you think that is in the U.S., or how challenging was it in Australia, branching those different areas of infrastructure? You had a power line, a transmission line that went to support Sydney Metro, as I recall. I mean, two very, very different kinds of assets. It's hard to imagine how that would work here in the U.S.
Well, everyone thinks they're unique. So, I've seen it right around the world. Every country thinks it's unique. Every county I've found in the U.S. thinks it's unique. No different really in a continent like Australia, which is the same area as the US, but with about 325 million fewer people. So it is, it is about what the priorities are and how it sells politically. We don't provide incentives for funding these TIFIA and all these other things that you're talking about. We don't do that. I mean, I think it's I don't see why mum and dad working in a nursing home or as nurses or doctors should be subsidising the borrowing of Wall Street. But so I'm a little critical of that, but that's just me. I think it's actually it's better to give more and more control to the counties and cities, and that you have a level playing field, so that everyone, whether you're borrowing money to build a new hospital or borrowing money to build a road or borrowing money to build a business, an airline, maybe you should have the same funding costs. And that levels the playing field, and it's reflected in the fact that you have a true cost of things. And look, I think politically, if you said to me, I'd be able to sell LaGuardia Airport and build 100 new schools in the area and put on, build 3 new hospitals, I could sell that. Let me have a go. I could have a go at that, no problems.
I believe him.
I believe him too.
Let's address the issue about the complexities of developing transportation projects. That let's just leave energy and hospitals to the side for a minute. Just even across different sectors within the transport space. I think a lot of people on the phone can empathize that it is complex, and you have multiple decision makers at the federal level and elsewhere that play into that. But I think that's an issue independent of asset recycling and not something we're anticipating in the future. We're there now as a transportation industry. In 2017, it's very unusual to find major transportation projects that, and look at the ones we've talked about today, they have a multimodal element. It's about technology and choice and transit, and we have a project in the 95 corridor that involves high-speed rail and freight rail and highway expansion and transit and HOV, and that's a modern transportation. That's the solution is going to look like. And so addressing reforms at the federal level that help minimize the decision makers, the single point decision making at the federal level, the streamlined review process, the coordination across agencies, all those are really important improvements to support transportation projects writ large, whether you look at an asset recycling program or not, because that is reflective of a modern transportation project, which, as most people on the phone have experienced firsthand, it almost always includes a multimodal element. So we need to move that direction as a government to be able to help support and facilitate and accelerate those kinds of projects anyway.
We have additional complexities here in the U.S. with a lot of the infrastructure owned by the private sector to begin with. Yeah. A lot of transmission lines and some of the works, things like that.
But that's the interesting politics of it, isn't it? I mean, just to defer back to politics. So in the United States, you're happy for the private sector to provide food that you eat, to build the roof over your head, to provide water and electricity, but there's no way you'd let the private sector run an airport. I mean, how does that work? I don't quite understand the logic of that. Maybe
I think some of those lines are being blurred now, particularly when you look at how in cities and metro areas how people are getting around, whether it's some of the new TNCs and some of the new private firms. I think those lines between public and private are getting more blurry every single day. It's the large assets where we still have a long way to go, I think.
And we were missing in the U.S. market. Australia obviously has been doing this for a longer period of time in some respects. But in the U.S., I think we were missing those high-profile success stories that said, you know what, you can develop these kinds of partnerships and you can deliver, results for your constituents, for your customers. Yeah. The government can meet its policy objectives, and the private sector can get a return on their investment as well. And now we've moved forward in the U.S. where you're looking at some of the network in Texas, you're looking at our Express Lanes network here, you're looking at the courthouse project, you're looking at projects across the country where they're showing LaGuardia, where you're seeing those results. And I think that will help pave the way in the U.S.
I think that's a really good point, because I don't want people on the phone call to think the US is a pioneer here, or Australia for that matter, because in fact the UK was one of the pioneers, as was Germany, and South Korea is one of the leaders in the world in P3s.
How about asset recycling?
Well, Australia, I started asset recycling, but it's now obviously stretching into other countries as well, because governments everywhere for the first time, they just can't keep borrowing money. I mean, we are hitting the wall for the first time in a very significant way, where you have no budget capacity and you have no interest rate capacity to add to the stimulant in the economy. The only way to get the global economy going is by lifting productivity, and investing in infrastructure lifts productivity. So it's the only way to do it. And if you haven't got the money to do it, I mean, the idea of subsidising borrowings is ridiculous, because it's never been cheaper to borrow money. So why would you subsidise, taxpayers subsidise borrowing money if it's never been cheaper than it is today to borrow money? The private sector is awash in money around the world. The Mexicans know this. As I said, Koreans, Japanese, the Germans, the French, Canadians. I mean, everyone knows this. It's not pioneering stuff.
And I think your point around the economic growth, the economic proposition here is one that we always kind of gloss over. We talk about just the condition of the infrastructure, the needs that we have, but we don't talk about the purpose of these. And Jennifer, was your point earlier, I think we do need some kind of inventory then on the state level. Then what are we trying to get done, and what is the purpose of the investments we're trying to make? Once we start to be clear about that, I think it will help this national discussion move a little bit further.
And if we can translate too, we throw around big numbers, $10 billion. I think as an industry and communities, we have to translate that $10 billion into, and they did a great job with this in New South Wales. That $10 billion equals improvements to these roads, additional rail lines here, additional safety improvements here. Because I think if constituents can see a benefit to their quality of life, to their commute, to the strength of their communities attached with that, it's not just a big check from the private sector. We have to translate that into real, meaningful transportation improvements that are going to help cities move better.
And you know what? I just saw an article the other day in New South Wales of a local councillor in the local community talking about the upgrade of the walking path next to a road, and that money came from the leasing of a port, asset recycling. And he got media in the local paper because he was spending $250,000 upgrading the local walking path.
Yeah.
So that's how it works. That's why, whatever the case, Washington can't be prescriptive about how the fund is accessed. Let the politics permeate up. Let the river flow in the wrong direction, if you like, and then you'll be able to get it through the difficult politics.
And how we begin to quantify, or at least talk about those bigger policy goals, because clearly you want to support projects with asset recycling that are more valuable than what you're leasing in the first place. And that term valuable then has to mean much more than just a monetary thing. There are other public policy goals, whether it's greenhouse gas reductions or social equity concerns. All of those things are tough to quantify, but they're part of the larger picture.
Oh, they're massive. I mean, the environmental benefits of having upgraded infrastructure far outweigh, even the cost benefit. I mean, we found that in the electricity grids, for example, when the government didn't have the money to upgrade electricity grids, and you had significant leakage, the private sector taking over the poles and wires has meant that they've invested in the infrastructure because they've got so much to lose. Mm-hmm. And that's the same with roads. I mean, governments will let the potholes. What's the incentive, other than people complaining to their local, representative? What's the incentive to fix a pothole on a road that you probably don't go on, right? So, actually, when it costs someone money, they've got an incentive to fix the pothole, and that's where the private sector comes in, and they're shareholders directly in that road.
We're just barely beginning to scratch the surface, I think, of a deeper discussion, but we're going to have to end it there. I want to thank you very much for taking the time. We've got a lot of questions we didn't get to. I apologize for folks on the phone. We're going to make this available, though, up on our website, our YouTube channel. You should definitely pay attention to those uploads there. I also did read the comments that were very complimentary of Jennifer and the ambassador in particular for your insights and for sharing these experiences with us. So we really want to thank you very much for taking the time. It's very, very helpful. And thank you all for your participation on the phone. ENO is going to stay engaged in these issues. We've been engaged in these issues for a long time. We're going to stay engaged. If you'd like more information about ENO, you can check out our website at www.enotrans.org. You can follow us on a variety of social media. You can see they're on the screen. And I also want to encourage you to subscribe to ENO Transportation Weekly, which is really an invaluable resource on all aspects of transportation policy and practice. Again, my thanks to Mr. Ambassador and to Jennifer Almond. And thank you all for your participation. Have a great morning, everybody.
Thanks.
Thank you.